So our speaker today is Bill Raymond. A little bit of background. Bill is the mortgage broker in the group. He has an MBA from the NYU Stern School of Business. He majored in finance. He also did some advanced study work at Wharton Graduate Business School. On a personal note, he lives with a cat who drives him crazy and a dog that keeps both of them in line. So without further ado, I'll throw it over to Bill.
There is a program out there that was designed in 1934. It's remarkably apt today, and it's really terrific. And I was going to try and give you guys an outline of what that program is and how it works, because it really is for everybody and all of your clients. The only people who it really doesn't apply to are the very wealthy, which isn't our main clientele. The FHA was started in the 30s under Roosevelt. The idea was it improved housing, it provided adequate home financing, it basically stabilized that mortgage market and allowed banks and people to start borrowing again. It then moved into become part of the housing and urban development for the next 40 or 50 years. It's been there. It was one of the key things behind the housing boom after World War II, helping veterans and soldiers get loans, which is when the housing boom in this country really took off. In the 80s, the economy was at points. The oil industry down in the southern parts of the country had tanked, and people couldn't get homes. The FHA stepped in, provided that liquidity, and kept people in their homes or allowed them to get homes. And today they insure over 34 million homes, which is, what, about a third of all the homes in the country? So what the FHA is, it doesn't provide any financing. It's not a lender. It's simply an insurance program. But what it's doing is insuring lenders against default by their borrowers. Well, I promise you, if you get an FHA approval, basically any bank is going to bend over backwards to give you a loan. They've got nothing to lose. So not only are they ready to give you a loan, but every bank doing that, but the kind of products that the FHA is financing become among the most hotly competitive among banks. So the famous lending tree example, when banks compete, it's in your interest. In this instance, is somewhat true in the macro version, because all the banks are really out there pressing 30-year fixed loans at a certain number. That's where the action is. You can get 10-year and 15 and 20. You can get ARMs and stuff, and a lot of those are well priced, but because some of those aren't going to be financed by the FHA, there's less. What does the FHA also do that's really sort of extraordinary? Because it's got much more generous qualifying terms than any other lender. So they're not only guaranteeing the loan, but they're guaranteeing loans for people that have a credit score of 620. 2 years ago, you'd say that's not bad. That's like getting a B. Today, you can't go to a bank with a 620 and get a loan. 680, 700 is fairly minimum. If you don't have any money in the bank, but you have enough to put down 3.5% of the purchase price of a home, FHA, that's fine. The key number that banks are always looking at, it's called a back-end ratio, where they take your home costs, mortgage, property tax, insurance, HOA dues, any mortgage insurance, divide that by your net income, and that percentage has to hit a certain number for the banks. Conventional banks these days is about 40-41%. The FHA will go 50, and I've gone above 55%. We've gotten to 55 and 60% approvals. So it means the amount, this talk about what's safe and how much you can give down, the FHA is absolutely the most generous in terms of extending credit to people. The loan limits that the FHA will do are also sort of extraordinary. If you want to buy a single family home, they'll lend up to roughly $730,000. Well, so even if you're only putting down 3%, you're looking at buying a home for $750,000. It might be beyond some people's dreams, but that's almost what we're here for these last 5 years, is people putting nothing down and getting these great homes. If you want to buy a 2-unit property, a duplex, it goes up to $900,000. If you want to buy 3 units, $1.1 million, and they'll finance $1.4 million if you want to buy a 4-unit property. The only condition has to be you have to live in one of those units. But even then, they make it easier to qualify to buy it, because they will ascribe rent to your unit for you to use as your income, even though you're living in the place. The more you get into the detail of the program, it's extremely adaptable to people. which is the intent. I mean, this, I honestly think, is one of those things the government really got right. They have sidereal programs. It's things like, if you were buying it, you don't have to buy a house yet. You can apply for a 203K loan, it's called, which is a $35,000 home improvement loan. They will not look at what's called the CLTV, the value of your house and thing. Many of those standard ratios, they just throw them out. And in particular, if you're buying a home that needs some repair work, you can build that into the loan at the time of purchase. And it's basically, the FHA is giving you an extra $35,000 to do home improvements. It's for anything but luxury, so no barbecue pits, but you need new kitchen appliances, you want to build a new roof, you got to put it into landscaping. Anything that's perceived as increasing the value of the property, the FHA is there to support it.
That would be for your principal residence, not for a rental?
Only principal residence. I mean, the rental would be only if you lived in 1 or 2, 3, 4 units of rent. There's no second homes, no investment properties. But they also, you don't have to be for purchases. Refinancing, the FHA is great. Cash out is allowed on these loans. And they even have a great program. If you ever have an FHA loan, there's it's coming into a lot of vogue now as rates drop. They have what's called a streamlined refinancing. They don't look at your income, they don't look at your appraisal, they don't look at your assets. They just want to see you're employed. They take your old loan, the FHA redoes it, and I've been doing these for clients. Basically, the client has to do nothing, and it's like getting an incredible loan modification. So we had one gal that bought a house last April. She was paying 7 1/8%. It cost her about $1,000 out of pocket. She now has a loan at 5%. It's a great deal. This is a great program. You don't have to be a citizen to get it. You just need to have a Social Security number. It has to be a valid Social Security number. Non-occupant borrowers can get in. You can have a child get in a loan with you, and then if they want to go off on their own, they can get their own FHA loan. So you can be on 2 loans as principal residences. I mean, it's a good deal. Are there any disadvantages? There's only about 2, and then I brought an example to hand out. The only 2 disadvantages, it's minor financial. There's a one-time 1.75% of the loan amount as a fee that's charged at the loan, but we built it into the loan. And you have mortgage insurance for at least 5 years. Mortgage insurance is a percentage of the loan you pay each month, because this is an insurance program. Nonetheless, it's less than conventional banks' mortgage insurance. Briefly then, I'll try and pass out, but at least you can see how the numbers work. This is from a true life scenario that Twee helped do, because she put me in touch with the realtor who I put in touch with my clients, and the deal closed this week. $260,000 home. Only one of the 2 parents and children, only one of the parents works. They had about $10,000, $12,000, maybe about $15,000, $18,000 in the bank. But they've been paying, if you see at the bottom, $1,700 a month in rent. They now own a $260,000 house for, basically, they put down about, you're saying, the down payment of $9,000. Everything else was covered by the FHA or built into the thing. You look down the payments, even that minimized the mortgage insurance, the guesstimate the payment of $1,453, but you can see their total out-of-pocket now is $1,902. They have a nice tax savings, which they wouldn't have as a rental. So in essence, they're paying, for them, substantially less than they were paying for rent, and they now own a $260,000 home. It's a deal that really wouldn't happen without the FHA. And on the basis of helping the economy and why the FHA is doing it, yes, it's a really sort of a nice organization, but the mandate is get people in homes, get these homes off the market, and not to think of it as a program for, yes, this is a low-income example, so it kind of contradicts it, but I assure you, I'm doing loans for people who just bought an $800,000 home, putting about 9% down, and they'll get a loan for $730,000. Absolutely doable. I really do appreciate it.
Thank you.
Thank you.